Hey everybody, Signa here with the Bullish Bears. In this video we're going to talk about the margin for trading futures. Now depending on your broker, your day trade margin is only going to be a quarter of the size of your daily margin, and those margin requirements may or may not be a pretty high value. So let's take a look at this. On Thinkorswim, you can click on the drop down menu here, go to futures, and it shows you, quote, initial margin. Now, that initial margin is what they throw out there for a conservative estimate of what they anticipate you needing to have to trade that futures product in your account. This number is based off of a government formula assessing the amount of risk to your account if you was to take one contract of this futures product in a trade and after you were in it the worst case scenario happened. Okay, so this is their risk assessment plot, and that value is going to be pretty close to most of your big brokers. So ROJ Futures or Thinkorswim, Tastyworks, Interactive Brokers, Fidelity, E-Trade, eSure, all those big name brokers that you could think of are going to have an initial margin value very, very close to the same numbers. And the reason for that is very simple. They're using the government formula. This initial margin is not exactly what your day margin or day trade margin would be. Typically, it's going to be 1/4 the size of what you're looking at here on the screen. So for an example, to trade the NASDAQ futures, which to point out, a month ago, you would have needed around $7,000 to trade one contract on the NASDAQ. You now need $9,350. Well, we only need 1/4 of that size. So what we would do to determine that, we could just bring up the calculator and we could take that $9,300 and divide that by 4, and we would need 1/4 of that, so $2,325 to trade one contract. That would be the required buying power. And the reason we need to bring this up is because if you're day trading futures and you hold them into the close, your margin requirement goes back to that initial margin. Okay, so if we go back to the NASDAQ, we could day trade this for 2,000 something dollars. But for each contract that we're holding into the close, the margin requirements or the buying power reduction requirements goes from that 2,000 number back up to this 9,000 number. You can see how that could cause you a problem. Now, a lot of the brokers that we talk about at the Bullish Bears are what we call the small account brokers. This would be companies like NinjaTrader or Tradevate, and they do not use that government risk assessment formula. They use a flat rate fee. Here on Thinkorswim, you could see that the ES, which requires $8,250 of initial margin, and the NASDAQ, which requires $9,000 of margin, they're different numbers. But if we was to go to NinjaTrader or Tradevate, they're going to require $500 to trade the ES or $500 to trade the NASDAQ. It's exactly the same. The Russell, $500, the same thing. It doesn't change. And then if you're going to trade the micros instead of the minis, it's $50 for the ES and $50 for the NASDAQ, $50 for the Russell. That is still the day trade margin, not the quote initial margin. So if I have 3 micro contracts, that's $150 of buying power, and I take it into the close, I suddenly need $600 of buying power to hold those because it went from 50 per contract to 200 per contract and I'm holding 3 contracts. Okay, so you can see how that can get out of hand drastic very quickly. And the reason we want to bring that up is because when your broker closes your trade down, a lot of them are going to hit you with a very big fee. On NinjaTrader and Tradovate, for an example, if they close your trade when you go into the close, because you can't handle the margin requirements, they're going to charge you $50 for the privilege of them closing your trade. It won't matter if it was a winning trade or a losing trade, they're going to charge you that $50. That is just giving away money that you don't need to give away. All right, so there's nothing wrong with holding a trade into the close if you can cover the initial margin requirements. If you're unsure at all, if you have enough capital to sustain the trade through the close, just close your trade. You can get right back into the market when it opens up with Globex. And Globex is just a really fancy word for saying overnight trading. Okay, so we break out the time zones on a 24-hour period when we're looking at the marketplace. We've got Globex, which runs from 6 o'clock at night until around 7:30 in the morning, and then we're in the pre-market, and then we're in the market. See, so everything is just broken down into these series of time. All of those series of time have their own special name, and that is where a lot of people get confused. But don't let the names throw you off, and just recognize that the government, being the government, wants to make things complicated and confusing. If you hold a trade into the close, the initial margin value kicks in. But if you close your trade and you open it up again 2 hours later in the Globex, you again only need that quarter size. Okay, and I find a lot of people who get thrown off by this when they first start trading futures, and they're literally just giving away money. So let's not do that. Okay, it is very easy to be able to recognize that the market is getting ready to close, right? It closes at 4:15, but by 4 o'clock, you really should not be in the market anymore, right? Trading at the end of the day is a dangerous time in the marketplace when it comes to trading futures. So you should already have recognized that that requires an extra level of skill. So perhaps trading towards the end of the day isn't something you should be messing with until you get some proof that what you do is safe in that time frame. But by 4 o'clock, you're going to look for an exit. And then at 6 o'clock, when the market opens back up, you can get right back in again for that same $50 initial margin or $500 margin, and you can hold it all the way through again. Now, what that looks like on a chart, let's just go out to a regular chart, a regular time frame. Let's save this where I want to be able to get back to that later on. And we'll just go look at a regular chart and demonstrate the easiest way to recognize your trading time frame. So here we are on the ES. We take that into a 5-day, 5-minute chart, and we turn on the daily indicator. You can search for that just by typing in daily. We want the daily open. And then we turn that on and we say show this on every single day, not just the one day. So here you can see when the market opened. Okay, we're going to zoom in here a little bit. The market opened up, and from the start of that yellow line all the way up until the line ended, that's how long you could stay in the trade. Now you really don't want to be messing around in this time frame here. Okay, that's a set time period that is not developed for retail traders. At 4:15, the market closes for us. There's a settlement period of about 15 minutes. And then between 4:30 and 5:45, close to 6 o'clock, trading resumes, but not for the retail trader. And it's just It's just not available to us. So it's not something that you can request and you're going to go out and get. You just can't have it. But look, it's 2 hours out of a 24-hour day that you can't trade. All right. Now, one more thing we can do with the styles is we're going to turn on the extended hours highlight, and this will kind of clear it up a little bit more. What you see in the dark part of my screen, that's the daily regular trading hours, RTH. And what you see in the gray, that's the overnight or the Globex. All right, so the gray line here, the gray dotted line, that's when the market opened in Globex, and it ran through the night into regular trading hours and all the way up into the close. That little bitty window right there is where you would not want to be in a trade if you could not cover the margin into the close. I know it doesn't make a lot of sense that you could open up a trade at night, say 6 o'clock, and you can hold it all night long and all day long, and you just need to get out of it before 4:15, and you never have to worry about that margin doubling up on you. But if you're holding it at 4:14 and you go into the close at 4:15, that contract goes 4 times higher than its a regular value, right? So $50 of buying power, suddenly you need $200 per contract. Leave it to the government to make something complicated that doesn't need to be complicated. What is going to happen to your trade between 4:15 and 6 o'clock when it opens back up again? Right? And how is that any more risk than holding it from 4:16 p.m. or from 6 o'clock p.m. all the way up until the next day at 4:14? And yet that is what we have to deal with. So recognize this. And your broker could be different than the brokers that I've talked about. You're a client of that broker. So if you are uncertain or unsure of what your initial margin is or your daily margin requirement is, your buying power per contract on the ES or the NASDAQ or the micro or whatever it is that you want to trade, you can call them. They won't be rude. They won't be disrespectful. They won't talk down to you. They're going to be friendly. They're going to be helpful, and they will give you the answers that you need. All right. You are a customer. They want your business, and they won't keep your business if they treat you badly. So just call your broker if you're unsure. And now you have a very good understanding of the margin when we talk about holding contracts in the futures and how each futures contract has its initial margin, its daily margin, and its day trading margin. And the word margin in this context does not mean that you're borrowing money or using money that's not yours, right? I know that when we step outside of the futures market and we just talk about opening a trading account, they ask, hey, do you want to trade with margin? And what they're really asking in that is, hey, do you want to trade with borrowed money? Now, a lot of people say, no, I don't. I would rather risk my own money and not risk yours money. I understand that completely. What we're talking about here has nothing to do with that kind of margin at all. And instead, think of this kind of margin as the required buying power. Okay? I know that we just need to find a new word for it, right? So again, this is Signet at the Bullish Bears, and I will look forward to seeing you at the next video.